Hi, I'm Jason Rarica with YellowWood Wealth Solutions. Wanted to shoot a quick video today to talk about some of the recent volatility we've been experiencing, why it's happening, and what you, as an investor, should be thinking about. So undoubtedly, if you're turning on the news today, you're going to see more than enough bad news for why the market is going up, or in our case, going down a lot more frequently. It's going to be Russia, it's going to be corporate earnings, supply chain, inflation, fears over recession, and on and on. The list never ends. But in our estimation, the two biggest concerns we have right now are inflation and fears of recession. So let's take a minute to talk about what each of those really mean and why they're a risk. So inflation, what is inflation at its core level? Inflation is nothing more than the increase of price for a good or a service, right? If you're gonna go to the store and buy a gallon of milk, and a gallon of milk costs X today and it costs X plus 1 tomorrow, that's inflation. So how does that inflation actually happen? There's a lot of different ways that it happens. Some of the ways it's happening right now are, for example, the increase of what they say are costs of goods sold, or essentially, what does it cost to make something that you would buy? Think of it as if you manufacture golf clubs. If you manufacture golf clubs, you have the cost of the metal itself, it needs to be assembled somewhere, and eventually it needs to be shipped to the United States. Well, given the COVID pandemic and some of the issues with shipping things to the United States, the cost of the raw materials of metals themselves, you can see how the cost of golf clubs might go up in order for these companies to stay in business. So that's an example of inflation due to the price of cost of goods sold. Another way that inflation can exist is if the balance of supply and demand gets disrupted. And in a way that has happened recently during the COVID pandemic, we issued a lot of stimulus checks to folks, and a good number of those were used to go out and buy different items that people wanted. And so if you wanted to buy something and you all of a sudden had more money, and your neighbor all of a sudden had more money and wanted to buy something, that creates an increase in demand. Couple that with some of the issues in the supply chain, you get a pretty clear picture about how we can get a disruption in that relationship, which also creates inflation. Now, some of these inflation numbers are what they call transitory. You might have heard that on the news. That's just business jargon for inflation that is not going to stick around forever. That they expect once the supply chain loosens up a little bit, that some of those inflation numbers will go away and prices will come back down. Not all of them, but some of them. There's another component of inflation, though, that is far less transitory and we think has actually a bigger impact on the inflation numbers we're experiencing right now. And in order to explain that, we got to nerd out for a minute, so just stick with me. So there's a term called the M2 money supply. What that is essentially, think about that as all the dollars that exist. So that's checking accounts, that's savings accounts, or any other item that can be easily converted into dollars. Now, if we increase the amount of that money that exists, that has an inflationary effect. Think of it as if I'm an apple farmer and you want an apple, you come to me, and let's say in this example, an apple costs $1. You give me $1, I give you one apple. Let's say overnight though, I doubled the number of dollars that existed. You come to me tomorrow and you want an apple, there's twice as many dollars, an apple's gonna cost $2. Creates inflation. So in our world, during the COVID pandemic, we did a lot of government stimulus. The Fed printed a lot of money. In fact, during the COVID pandemic, they printed roughly 34% more dollars than we already had. So that is to say that we just added a bunch of money to the system that has an inflationary effect. That inflationary effect, that's not transitory. That one's going to be baked in for years and years to come, unfortunately. So how does this relate to a recession and fears about us going into a recession? Well, it relates to a recession by way of interest rates through inflation. So you might have heard the Fed has raised interest rates and has planned to continue to raise inflation or interest rates, and they're doing it because they believe they have a mandate to try to control inflation through this measure. And that's true. However, the Fed has a pretty bad track record of raising interest rates too quickly and putting too much strain on our economy, which can push us into a recession. Also, the Fed raising interest rates doesn't impact the amount of M2 money supply that exists, like we talked about. That's going to be the money in your savings account and your checking account. By raising interest rates, they can't take their hands and put it into your checking or savings account and take those dollars out of the system. They still exist. So they can really only impact one end of the inflationary numbers. And unfortunately, in our view, that's the smaller component of the inflation that we're experiencing right now. So what that really means is, from the stock market's perspective, they're always looking 12 months down the road. The stock market, the things you see happening today are not directly because of things just happening today. It's expectation of where things are going to go. And so there is a fear that the Fed will once again raise rates too quickly, put too much strain on the economy, and push us into a recession. Now, there's another component of this that I don't think is talked about all that much, and that is that the Fed really doesn't have much of a choice. So they probably should have raised rates a few years ago when the economy was strong and we weren't having as many inflationary pressures. They didn't do that. In fact, they eased during COVID and that, but those are all things we can argue about at a different time. The point is now, if the economy were to go into a recession and the Fed hadn't raised interest rates, they don't have very many tools in their toolbox in order to stimulate the economy. And that's one of their primary objectives. So in some ways, the Fed has to raise interest rates in order to put tools back in their toolbox so that if we go into a recession, that they have something available in order to help stimulate the economy and get us out of the recession. Speaking of recessions, everyone gets super scared about those because no matter how far away 2008 goes back into our memories, that had an emotional scarring effect on everybody. But it's also healthy to understand, what does a recession really normally look like? Since 1980, we've had 6 recessions. The longest recession we had was 2008, went for about a year and a half. The shortest recession we had was the COVID pandemic, which was just a couple months. On average, though, a recession lasts about 10 months, and then we go ahead and we recover from that, and we start to grow, and the economy starts to go forward from there. So what are you, as an investor, supposed to do right now? What should you be thinking about? So I think this all starts with having good, sound investor behavior. That's investor behavior. That's your behavior. Whether you invest for yourself or outsource the investment of your money to somebody else, to a professional. It's important that you have the proper behavior, that you don't act emotionally, that you don't act irrationally. Historically speaking, investors have a bad track record of doing that. In fact, if we look at a 30-year time horizon ending in 2019, the average investor return in the equity markets made about 5.04%. The average investment return made about 9.96. So that's about a 5% difference for the investments to outperform the investors. Another thing to think about is, if you're 50 years old, you've lived through 3 50% corrections in the S&P 500. So when you think about a possible recession occurring in that, take that with a grain of salt as far as what you should be doing. And if you're afraid and you think you should maybe be getting out of the stock market, you've experienced this 3 times if you're 50 years or older. In fact, if you're 25, you've experienced it twice. And the average investment return in the S&P 500 for the last 50 years has been about 10.5%. Now, that's not to say that you don't do anything, but it's important that you have good investment behavior and you stay invested. And I think that really comes back to having the proper confidence in what your plan is. A, do you have a financial plan? And B, do you have confidence in that financial plan? Which I think all of that is derived from having very clear goals about what you're trying to achieve, so that you know directionally where you're going and are you on track to achieve those goals. And when the market gets volatile in that, can you see that you're still on track in the long run? Can you get the confidence from that? Have you divided your investments up into different buckets? Different dollars should go into different buckets, and those buckets should be tied to different goals. Some of your goals might be 5 years from now. Some of your goals might be 10 years from now. Those should have different risk tolerances associated with them. So if you divide them up into buckets, and if you know that money you might need in 5 years is significantly less risky than money you might need 10 or 20 years from now, when you go through volatile times, it's a lot easier to see that happen and not freak out, because the money you might need sooner has less risk associated with it. The last thing I would say is, be intentional in the decisions that you're making. Think of it as you're driving a cruise ship, right? You're not going to be just making a 90-degree turn. You're going to make slow, methodical, and intentional decisions with all of your money. So some of those aren't sexy, but they are good things for you to do. For example, consider tax loss harvesting. The market's pulled back quite a bit. There's an opportunity to look at, well, I might have some losses now. It's only May. That's okay. Think about taking some losses now and booking those and having them. And even if you don't recover this year altogether, you can save those losses for future years. Another one would be rebalancing. We talked about the risk in the different buckets. When the market goes down, obviously not everything goes down at the same rate. And so because it doesn't go down at the same rate, you're going to probably need to be rebalancing your accounts so that you can get back to what was the proper allocation mix to begin with. And then another thing is you can buy on sale. If you're an investor and you have some cash and you're afraid to get into the market because it's volatile, right now things are on sale. It's a pretty good time to buy some things. Be intentional about what you're buying. Make sure it aligns with what your worldview is and what your risk tolerance is and what your goals are. So that might mean you buy something aggressive. You might buy a bunch of tech stocks that are really taking it on the chin. If you're not a more risk-on investor, then you might think about doing something a little bit more conservative. You might buy some value stocks, which you might look at buying some buffered investments that give you some downside protection, but give you the ability to participate in upside market gains. So there's a couple things that you should consider. All in all, the best public service announcement I can give everybody right now is to just know, whether you're watching television, listening to the radio, reading the newspaper, or frankly pulling up any website on the internet right now, all of those companies are in the business of converting your time into their profits. Their entire business model is set up to give you something, to cast out a line to you with something on that hook to get you to bite so that they can turn your eyeballs and your time into dollars in their pocket. They're not always acting in your best interest, and you need to be acting in your best interest. So if you have any questions, or if there's anything we can do here at YellowWood Wealth Solutions to help you or somebody you know, please feel free to reach out to us. We're always available. Have a great day.